Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Thursday, April 24th. At the current pace of things, Starbucks may soon have to change the name on its doors to Starbust. Macro pressures, heightened competition, and the company's own miscues have led to a deterioration in its operating performance and, quite clearly, to a deterioration in its stock price, which is down 60% from the all-time high it hit in November 2006. Today, the stock has been dealt another serious blow after Starbucks said it now expects second quarter revenues to be up just 12% and earnings per share to be 15 cents versus 19 cents last year. The second quarter earnings number includes a restructuring charge of 3 cents per share, but when that's excluded, Starbucks still comes up well short of the 21-cent first call consensus estimate. In terms of the fiscal year, Starbucks expects earnings per share to be somewhat lower than the 87 cents per share reported in fiscal 2007. Now, the current first call consensus estimate is 97 cents. The disappointing guidance was attributed to the sharp weakening in the U.S. consumer environment, which for Starbucks manifested itself in a mid-single-digit decline in U.S. comparable store sales in the second quarter. Starbucks tempered its full-year outlook in the manner it did because it expects continued weakness in the U.S. consumer climate. On the bright side of things, CEO Howard Schultz has recognized that the company has to get back to its roots of providing a great experience for its customers and much better returns for its shareholders. Part of that process includes slowing the rate of new store growth, closing underperforming units, boosting international growth, and introducing new products. The latter is perhaps the most important, as Starbucks has to find a way to drive increased traffic back to its stores in the face of stiffer competition from the likes of McDonald's, Tim Hortons, and Dunkin' Donuts. In a tough economic environment, it's not enough to provide overstuffed couches and cool music when consumers care more about their understuffed wallets and having the money to add new tunes to their iPods as opposed to spending money on that extra frappuccino. Starbucks faces an uphill battle, and the macro pressures are going to forestall its turnaround efforts. Fortunately, the company still has great brand equity that gives it an edge in working to get things turned around. Now, this situation is not unlike the trouble McDonald's found itself in several years ago, and which led to its stock trading as low as $12 per share. Today, McDonald's stock is pushing $60 per share as the company engineered a truly remarkable turnaround that was focused on driving sales at existing stores, improving customer service, and introducing innovative menu offerings as well as a value menu that would appeal to all of its customers. Importantly, McDonald's also reset the expectations bar for investors, having offered realistic long-term forecasts that weren't necessarily robust but were ultimately achievable. As for Starbucks, it did not provide any precise fiscal 2008 earnings guidance due to a lack of visibility into near-term economic conditions. It did say, though, that it will provide expectations for key financial metrics for the next 3 years on April 30th. Here's hoping Starbucks brews a more conservative growth picture, because it has become clear to the market that it isn't the growth company that it used to be. Starbucks must own up to that and provide more realistic sales and earnings growth forecasts. Until it does, its stock will continue to be driven by misguided expectations. I'm Pat O'Hare for Briefing.com. Thanks for listening.